When we talk about day trading, we're entering one of the most dynamic, high-velocity segments of market activity. This is the part of trading where positions live fast and die young, where everything happens inside one single session, and where the trader's mindset, discipline, and technical readiness determine everything. So before we dive in, let me set the stage for what day trading really represents. It is not long-term wealth compounding, and it is not strategic position building across cycles. Instead, this is about identifying micro-movements, extracting efficiency from intraday volatility, and executing decisions at a pace that leaves absolutely no room for hesitation. In this episode, we unpack what day trading is, how it works, the strategies that define it, the tools traders depend on, and a full case study that shows how all these components converge in real-world execution. At its core, day trading is exactly what the name implies: buying and selling financial instruments within the same trading day. Positions are opened and closed before the bell. Nothing is left overnight, and that deliberate choice eliminates one of the biggest risks that active traders face: exposure to gaps, earnings surprises, geopolitical shocks, or any unpredictable overnight developments. The day trader aims to exploit small fluctuations that play out minute by minute, sometimes second by second. A long-term investor might see these movements as noise. But the day trader sees signal, opportunity, and a field of micro-patterns waiting to be capitalized on. And this means that the holding period for a position is short by design. You can think of it as the opposite of strategic patience. In day trading, the market gives you an opening, you take it, and if it does not materialize quickly, you cut the trade and move on. That is part of what makes the style both difficult and fascinating. Many day traders will execute multiple trades throughout a session. Not because they are gambling, but because the entire structure of this trading style is built on repetition, small edge exploitation, and continuous opportunities. And because movements are small, many rely on leverage. With leverage, they can amplify returns on tiny intraday moves, although of course this also amplifies risk. Which is why strict risk management becomes the backbone of any sustainable day trading practice. Another defining element is the reliance on technical analysis. When you're trading intraday volatility, fundamentals simply don't move fast enough to matter. Instead, charts, patterns, indicators, and order flow dynamics become the trader's GPS. And this brings us directly into the strategic layer of day trading. The techniques vary widely, but most active intraday traders operate under one of several strategic frameworks. The first group are scalpers. These are the ultra-short-term specialists who look for micro-movements, often targeting just a few cents or points at a time. Their thesis is that many small wins, compounded over dozens of trades, can outperform a single large move. Scalping demands relentless focus, instantaneous execution, and a frictionless trading platform, because even minor delays can erode the advantage. Another major framework is momentum trading. This is all about identifying assets moving strongly in one direction on high volume and jumping onto that directional wave with the expectation that the movement will continue. Momentum is powered by trader sentiment, liquidity surges, institutional participation, and behavioral patterns. When a stock accelerates rapidly in one direction, momentum traders position themselves in the same direction, not because they are guessing but because the market is demonstrating real-time conviction. A third approach is breakout trading. Here, the trader looks for moments when price breaches a key support or resistance level. These levels are psychological as much as technical. When price breaks out, trapped traders, stop orders, and new entrants often accelerate movement in the breakout direction. A breakout trader wants to catch that acceleration and ride it until momentum fades. Then we have reversal traders. These traders seek exhaustion points, moments when the market becomes temporarily overstretched, either overbought or oversold, and begins to revert back toward the mean. The idea is not to fight the major trend but to identify short-term dislocations where price has pushed too far, too fast, and is statistically likely to correct. And finally, there are news-based traders who position themselves around economic releases, earnings announcements, central bank comments, geopolitical headlines, and any strong catalyst that generates immediate volatility. This requires incredible discipline, because news can create both opportunity and chaos within seconds. But for the trader who understands how markets react to catalysts, news events can present some of the best risk-adjusted setups of the entire day. All of these strategies depend on tools, and those tools define whether a trader has a competitive edge. Technical indicators such as moving averages are used to identify trend direction. The RSI helps determine when the market is overheated or exhausted. The MACD provides insight into momentum shifts, revealing when a trend strengthens or weakens. Bollinger Bands give visibility into volatility expansion and contraction. None of these indicators predict the future, but they give traders structured context so that decisions are made with clarity, not guesswork. Beyond indicators, chart patterns play a critical role. Head and shoulders formations, double tops and bottoms, and various triangle configurations are highly informative in day trading because intraday price often respects these structures with remarkable consistency. They represent trader psychology visualized on a chart: fear, enthusiasm, hesitation, accumulation, breakout potential. To support all of this, the trading platform becomes mission critical. Day traders require real-time data, millisecond execution, and advanced charting capabilities. MetaTrader, Thinkorswim, and NinjaTrader are commonly used because they are engineered for speed, flexibility, and precision. Latency becomes a risk factor, and execution quality becomes part of the trader's operational edge. Of course, none of this matters without risk management. Day trading is fast, which makes losses equally fast if not controlled. Stop-loss orders are essential so that adverse movements do not spiral into large drawdowns. Position sizing ensures that no single trade carries disproportionate risk, and diversification across different assets or setups protects against correlated losses during volatile sessions. To illustrate how all of this comes together, let's walk through a case study of a trader named John, an experienced day trader who specializes in equities. John focuses on breakout strategies. One of the stocks on his radar is XYZ Corp, which has been consolidating within a narrow range for several weeks. The price has repeatedly respected support at $45 and resistance at $50. This kind of consolidation excites breakout traders because it signals compression. When price compresses, it does not stay quiet forever. Eventually it breaks. John performs his pre-trade analysis. He notes the tightening range and observes that volume has been steadily increasing. For breakout traders, rising volume during consolidation is one of the strongest signals that an explosive move may be coming. He decides that if the stock breaks above 50, he wants to be in the trade. But he manages his risk carefully. Instead of jumping in exactly at 50, he places a buy order at $50.50. Giving room for confirmation so that he does not get caught in a false breakout. His stop-loss is placed at $49, just below the breakout level. And before placing the trade, he calculates his position size so that he never risks more than 2% of his capital. The trading session begins. During the first hours of the morning, volume builds. The market is clearly watching this level. When the breakout finally happens, it happens decisively. Price surges past 50, hits John's entry at 50.50, and continues upward with strong momentum. By midday the stock has reached 52, consolidates briefly, then pushes further to 55. John does not rush to exit. Instead, he adjusts his stop-loss upward to protect profits. This is trade management in action, locking gains without cutting the trade prematurely. As the day progresses, the move extends even further. The stock reaches 57, but then John begins to see signs of exhaustion. Volume fades a little. Candles begin to show wicks. Momentum stalls. He decides to close his trade at 56.50. On a position of 500 shares, he walks away with a profit of $3,000. What matters is not just the monetary outcome, but the process he followed: clear analysis, disciplined entry, structured risk management, and rational exit timing. That case study demonstrates the essence of day trading: speed, precision, preparation, and emotional discipline. Day trading can be rewarding, but only for those who treat it as a professional craft, not a gamble. It requires consistent education, constant practice, and a strategic mindset, because the market moves fast and punishes hesitation. When traders understand their strategy, their tools, and their risk parameters, they can navigate the intensity of intraday markets with confidence and structure. And that is the foundational lesson of Tip 53: day trading is not chaos. It is choreography. It is the disciplined execution of short-term opportunity in a highly volatile environment.
Thank you for listening to the Ultimate Trading Podcast by Bells Forex AudioWorks. If you love this episode, hit follow, leave a quick rating, and share it with one trader friend. It really helps. Right now, head to bellsforex.com/tools. 6 professional-grade trading tools, 100% free, no sign-up. Use them on every trade. They're that good. Full guide is free at bellsforex.com or grab the Kindle version on Amazon. Until next episode, trade smart, stay disciplined, and keep building your edge. Happy trading!